studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
Throughout this case study, we've examined several different types of investment income. We've looked at interest income, we've reviewed rental income, and we've calculated taxable capital gains through Schedule 6. At first, these may seem like separate topics, but inside the T2 return, they eventually come together in one place. That place is Schedule 7. This is why Schedule 7 is often described as the central hub of corporate investment income. Let's begin on the left side of the slide. Notice the three major sources of investment income flowing towards Schedule 7. The first source is interest income. In the Barnes Dentistry case, the corporation earned $17,600 of interest income. This income may have come from bank deposits, guaranteed investment certificates, bonds, or other interest-bearing investments. The second source is rental income. Barnes Dentistry earned $5,750 of rental income during the year. This income comes from property activities and represents another form of passive investment income. The third source is taxable capital gains. Remember that Schedule 6 calculated a capital gain of $10,800. After applying the 50% inclusion rate, the taxable capital gain became $5,400. That taxable amount is what ultimately flows into Schedule 7. Now look at the center of the slide. Think of Schedule 7 as a command center receiving information from multiple sources. Its primary role is not to create income. Its role is to collect, organize, and summarize investment income information. As each income stream enters Schedule 7, the schedule combines them into a single investment income calculation. Notice the investment income summary displayed on the Schedule 7 dashboard. Interest income of $17,600. Rental income of $5,750. Taxable capital gain of $5,400. Together, these amounts produce aggregate investment income, often called AII. The total AII for Barnes Dentistry is $28,750. This is one of the most important outputs generated by Schedule 7. Now let's move to the right side of the slide. Once aggregate investment income has been calculated, the information begins flowing into other parts of the corporate tax system. The AII figure helps support investment income tax calculations. It contributes information used elsewhere in the T2 return, and it provides data that may affect refundable tax accounts and other corporate tax calculations. In other words, Schedule 7 does much more than summarize income. It supplies information that influences multiple tax calculations throughout the return. This is why Schedule 7 occupies such an important position within the corporate tax framework. Now look at the panel labeled, "Why Schedule 7 Matters." The message is simple but important. Schedule 7 is the collection point for corporate investment income before tax calculations begin. Without Schedule 7, investment income would remain scattered across different sources and schedules. Schedule 7 brings everything together into a single, organized framework. The flow diagram at the bottom of the slide summarizes the process perfectly. Interest income flows into Schedule 7. Rental income flows into Schedule 7. Taxable capital gains flow into Schedule 7. Schedule 7 calculates aggregate investment income, and that information is then used in investment income tax calculations and throughout the T2 return. This is the master role of Schedule 7. The key takeaway from this slide is simple. Schedule 7 is the central hub of corporate investment income for Barnes Dentistry. It gathers interest income, rental income, and taxable capital gains, and combines them into aggregate investment income of $28,750. That information then becomes the foundation for several important tax calculations throughout the corporate return. In the next step, we'll see how Schedule 7 connects to refundable tax accounts and why investment income can eventually create future tax refund opportunities. We've already learned that Schedule 7 acts as the central hub for corporate investment income. It gathers interest income, rental income, and taxable capital gains and combines them into aggregate investment income. Now let's see what happens after Schedule 7 has completed its work. The key question is, how does investment income eventually connect to refundable tax accounts? Let's begin on the left side of the slide. Schedule 7 has calculated aggregate investment income of $28,750. This amount is made up of three components: interest income of $17,600, rental income of $5,750, and taxable capital gains of $5,400. Together, these amounts form the corporation's aggregate investment income, or AII. At this stage, Schedule 7 has completed its primary role. The investment income has been identified, classified, and summarized. The next step is what happens inside the corporate tax system. Now move to the center of the slide. Think of the corporate tax system as a processing machine. Investment income enters the system and becomes part of the corporation's tax calculations. Because investment income is generally taxed differently from active business income, special tax rules begin to apply. These rules often result in higher corporate taxes on passive investment income. As the tax calculation is performed, something important happens. Certain taxes generated by the corporation are not intended to be permanent. Instead, they are tracked separately as refundable tax components. This is one of the most unique features of Canadian corporate taxation. Unlike ordinary taxes, these amounts may eventually be recovered by the corporation. Now let's move to the right side of the slide. Here we see the refundable tax accounts. The most important account we've studied is RDTOH, or Refundable Dividend Tax on Hand. In the Barnes Dentistry case, Schedule 3 calculated Part 4 tax of $8,395. That Part 4 tax was added to the corporation's RDTOH account. As a result, Barnes Dentistry created an RDTOH balance of $8,395. Notice the calendar icon beneath the RDTOH account. This reminds us that the refund does not occur immediately. The balance simply waits inside the refundable tax account until a future dividend payment creates an opportunity for a refund. Now let's look at the panel titled, "What Creates Refundable Taxes?" There are three major sources. The first is dividend income. Dividend income can generate Part 4 tax through Schedule 3. The second is Part 4 tax itself, which is generally refundable under specific conditions. And the third is certain investment income taxes that may also contribute to refundable tax balances. Together, these mechanisms ensure that some corporate taxes remain temporary rather than permanent. This is why refundable tax accounts are such an important part of corporate tax planning. Now let's follow the flow diagram at the bottom of the slide. The process begins when investment income is earned. That income is reported in Schedule 7. Corporate tax is calculated. Refundable tax components are created. Those amounts are stored in refundable tax accounts such as RDTOH. The corporation later pays dividends to shareholders. And finally, a refund may be received from the Canada Revenue Agency. This simple flow captures the entire relationship between investment income and refundable taxes. Notice the key takeaway on the right side. Investment income generates taxes, but some of those taxes are temporary and tracked in refundable accounts like RDTOH. This idea is central to understanding the Canadian corporate tax system. The government collects tax today, but under the right circumstances, part of that tax may be returned in the future. The key takeaway from this slide is simple. Schedule 7 does more than summarize investment income. It begins a chain of events that can eventually lead to refundable tax accounts and future tax refunds. For Barnes Dentistry, investment income flowed through Schedule 7, entered the corporate tax system, contributed to refundable tax balances, and created future refund opportunities through the RDTOH mechanism. In the next step, we'll zoom out and look at the complete investment income ecosystem, connecting every schedule, every tax calculation, and every refundable tax account into one master flow diagram. We've now reached the big picture. Throughout this case study, we've explored many different schedules, calculations, and tax concepts. At times, each topic may have seemed independent, but in reality, every component is part of one integrated corporate tax system. This slide shows that complete system from beginning to end. Let's start at the far left side of the diagram. Everything begins when the corporation earns income. In the Barnes Dentistry case, there are 4 major investment income sources. Interest income of $17,600, rental income of $5,750, eligible dividend income of $21,900, and taxable capital gains of $5,400. These income sources represent the raw material that enters the corporate tax system. The next stage is reporting. Each type of income follows its own path. Interest income and rental income flow into Schedule 7. Dividend income flows into Schedule 3. Capital gains are first reported in Schedule 6. This is the first important lesson. Different types of income have different reporting schedules, but those schedules are not isolated. They are all connected. Now let's move to Stage 3. This is where the major tax calculations occur. Schedule 7 calculates aggregate investment income of $28,750. Schedule 3 calculates Part 4 tax of $8,395. Schedule 6 calculates the taxable capital gain of $5,400. At this stage, the schedules are transforming accounting information into tax information. The next stop is Schedule 1. Notice the bridge shown in the center of the diagram. Schedule 1 acts as the connection between accounting income and taxable income. It gathers information from the various schedules, applies tax adjustments, and calculates taxable income. This is where accounting becomes taxation. Once taxable income has been determined, we move to corporate tax payable. This is the stage where federal tax, Part 4 tax, investment income tax, and other applicable taxes are combined to determine the corporation's overall tax liability. For many students, this feels like the end of the story. But corporate taxation has one more important layer: refundable tax accounts. Now look at Stage 6. Part 4 tax generated by Schedule 3 is transferred into RDTOH, or refundable dividend tax on hand. For Barnes Dentistry, Part 4, tax of $8,395 created an RDTOH balance of the same amount. This balance represents refundable tax that may be recovered in the future. The next stage is future dividend payments. At some point, the corporation distributes profits to its shareholders. This dividend payment becomes the trigger for the refundable tax system. The corporation has now reached the event that allows refundable tax balances to begin flowing back. Finally, we arrive at the last stage, the tax refund. When the required conditions are met, the corporation may receive a refund from the Canada Revenue Agency. As the refund is received, the RDTOH balance is reduced. The refundable tax account has completed its purpose, and the cycle is complete. Now let's step back and look at the mental model shown at the bottom of the slide. Income is earned. Schedules process the income. Tax calculations are performed. Taxable income is determined. Corporate tax is calculated. Refundable tax accounts are created. Dividends are paid. And refunds are received. This single flow captures the entire investment income system inside a Canadian corporation. Notice the final message at the bottom of the slide. Corporate investment income flows through schedules, taxes, refundable accounts, and ultimately back to shareholders. That sentence summarizes everything we've learned in sections 5 through 11. The key takeaway from this slide is simple. Corporate investment income is not a collection of separate calculations. It is a connected system. Interest income, rental income, dividends, and capital gains each follow their own reporting paths, but they eventually converge into one integrated corporate tax framework. Understanding that framework is what transforms someone from a schedule preparer into a tax professional. And with this diagram, you now have the complete map of how investment income moves through the Canadian corporate tax system, from the moment it is earned to the moment a refund is ultimately received.